I'm Shae Russell for mining.com.au, and in this special episode of Drilling Deeper, I am joined today by Sean Russo, the principal for Noah's Rule, and Hedley Widdup, the managing director for Lion Selection Group. Gentlemen, thank you so much for being here today.
Thanks for having us, Jay.
Nice to be here.
Guys, I know we are here to talk about the RIU Investor Roadshow that is coming to Sydney and Melbourne on the 23rd and 24th of September. But before we talk about stocks and other commodities, I think we've got to start with, well, it's not even an elephant in the room. You can't ignore it everywhere you go. And that is gold. Now, I have been warned to not state the price of gold at the time of recording this. Sean, I'm going to come to you, obviously, because gold is a special area of interest for you. Tell me, where do you sit with the gold price right now? Because it does seem quite elevated.
Well, it's definitely elevated. It keeps on making new records week after week. I mean, I think the interesting thing is, it's only the beginning of September that we broke, in Australian dollar terms, that we broke the highs that we made in April, in the week between Easter and Anzac Day, right? So that's taken a while since, so middle of April to September to break new highs. In US dollar terms, it had been a little bit stronger, but again, we've been in that sideways trading range. What we think is particularly interesting, and people who've seen me give presentations, RIU and the things in the past, our scoring system, we hit a sort of a +6 out of a possible -6 to +6 for gold in April. Generally, when we've made those highs in the past, where you get a scoring of +6, where it's just really the energy, the buying energy is really strong, markets tend to correct very substantially after that, or they trade sideways for long periods to essentially take that energy out of the market. And this is the shortest period of time since 2000 where we've hit a level that high, and then we've made new highs. So it took anywhere between 6 months and 2 years between 2000 and this year to breach those highs once they were made. They nail great big things on the chart where you go, this is a level that is really significant, and that's what we saw between Easter and Anzac weekend in that time frame, and we've broken that. And we've broken that in the record time in the last 25 years. So this is the fastest time the market has been taken to a level like that, drawn breath, really hardly retraced. We hardly had a retracement. Aussie dollar gold briefly went back below 5,000, and then it was on again. US dollar gold similarly. So I think it's exciting. I mean, the market has lots of energy. And the other thing I will say is there's a couple of commentators whose opinions I value significantly and have in the past, and were very bullish when everyone wasn't bullish about gold, that are losing faith in gold again and think, it's overdone. So that's quite good, I think. I mean, not everyone's in agreement, but our scoring is much smarter than us. So I always stick to our scoring, and our scoring is telling us that this is the energy still here in this market, and this is kind of unusual. This is one of the best breaks of a high we've had in 25 years. So stay tuned.
I'll come back to something else I want to tap into regarding gold and equities with you in a moment, Sean. But Hedley, you're well known for commenting on gold. Where do you think the sentiment lies when it comes to gold and investing in gold?
12 months ago, it was the kind of thing that generalists were struggling to accept. And I think a lot of people had kind of become aware that the gold price had gone up. But, it was kind of, maybe that's a bit lucky. It's been driven by something we don't understand. And going back that far, I think a lot of what was driving the price was probably Eastern markets, a lot of BRIC nations, central banks and investors in those jurisdictions, which are not typically the parts of the market which drive the way that Western markets behave, whether that's for gold or anything else. So fast forward 12 months, I feel as if that recognition is setting in that the gold price has come from somewhere, is going somewhere, and that's worth starting to speculate on. It's making mainstream press. It's coming out in a lot of generalist type commentary that goes across the market and financial markets. So when gold enters that space, I think that's probably one of the things that sits behind the factors that make its way into Sean's scoring. Whether it manifests in the way they measure it or it's what results in the scores coming up. So we've seen Western ETFs come a little bit more to the party. And I think that's evidence, not necessarily of ETFs driving the price, but Western investors coming along. And we've seen gold equities, not just producers, but we've seen that sentiment of if gold price is going up, maybe we should be buying gold companies. shift from producers down into some of the micros and the explorers and the hopeful developers, which I think is probably the biggest part of it, because you take a lot more risk on a company, stock-specific risk, by getting involved in something, especially an explorer or developer. So if investors are willing to do that, I think it probably is a signal that belief in the gold market has set in a bit.
I'll come back to the micro-cap gold juniors in just a moment. Sean, I wouldn't mind just asking you a question. You've made a point in the past that gold is expensive, but you compare it to the general equities market. Can you elaborate on what you mean by that?
Yeah, sure. Gold is expensive if you look at it in dollar terms. It's never cost more to buy it in Australian dollars. So it's expensive in that sense. But if you look at it relative to the Dow Jones, you could only, if you sold a unit of the Dow Jones in 2011, you could only buy 5 ounces of gold. Today you can buy 12 and a half. All right. So although the gold market has gone up, the stock market has gone up more. So gold still is relatively cheap relative to equities. You could take your parcel of equities that you'd bought, you could buy 12 and a half ounces of gold, whereas in 2011, the last really sort of significant high at the end of a very long bull market, you could only buy 5 ounces. So that's in that terms, it's cheap. And I think that, and then silver is interesting, because then silver is incredibly cheap, because only the other day you could sell 1 ounce of gold and buy 100 ounces of silver. And at various times in the past, for 1 ounce of gold, you could only buy 30 or 40 ounces of silver. We're at the other end of the cycle when silver's really strong. And in fact, I think it was about 40 to 1 in 2011, right? So as cheap as gold is, silver's even cheaper. But yeah, so gold is cheap relative, certainly relative to general equities. And I think, and coming to Hedley's point, my observation is that the thing that's been missing, that was missing for a long time in the metals markets, commodity markets, in the equity side, was although the commodity equities look cheap, you couldn't get a generalist investor to sell CBA or to sell some of these other stocks. Why would they? It's still an uptrend. It's still going up. So why would they venture over where it's risky and dangerous if they can stay where they're kind of supposed to hang out, in banks and things like that? But one of the things that's been very interesting recently is like CBA, got to incredible levels. Everyone's saying, well, it's just too expensive. Well, where do you take that money if you decide to sell some CBA? Well, for one CBA share, you could buy 5 BHP shares, and that only happened, the last time that happened was in 2015 and 2000, right at the lows of the commodity boom. So everywhere we look, there's been this relative disparity where commodities generally are cheap relative to equities. Gold looks expensive relative to all the other commodities, but it doesn't look expensive relative to equities. But you have to believe that equities are overvalued for the generalist investors to say, right, I'm going to sell those things and I'm going to come and buy gold. And I believe that's happening, because the ratio of gold to the Dow today is exactly the same it was at the peak in COVID. So where gold is trading at like COVID peak highs against stocks at 12 and a half. Gold goes stronger from here. There's a lot of room between there and 5 just to get back to where we were in 2011.
Hedley, bouncing back to you, you hinted at it in your answer before, and this is talking about obviously the gold price flying higher and starting to lift other producers with it. Now, I know not all commodity prices are rising together, but are you starting to see an increased appetite for commodities in general, or stocks related to, mineral exploration?
Yeah, short answer. The longer part of the answer, I think there's a couple of parts to it. But if you were to track big cap versus small cap indices, since sometime in the first quarter this year, we've seen for the first time in probably 2 or 3 years, the small cap indices start to outperform its big cap big brother. And you can split the market into whatever stock jurisdiction you want, resources, industrials, whatever. I think that is becoming evident. So share risk taking in terms of investors putting money into shares, I think, is potentially on the rise across the market. But driven by the gold price, we've seen investors, and perhaps driven by maybe small caps are okay, but I think you can't ignore that gold price has gone up magnificently. For a long time, explorers had been left behind. So the producers got a leg up in performance with the gold price very early on. So 2-3 years ago, as this was starting to move, the producers were moving with it. It's only in the last 12 months that we've seen the development hopefuls be the first movers in the gold space. So, the $100, $200 million market cap companies that aren't producing anything, but are probably closest to the point where they could, got the first performance. And we're seeing it in explorers now. So explorers are a very long way from being exposed to the gold price. It's just now we can see the transmission of gold price is going up, I'm prepared to pay more for an exploration company. And if that spreads across the market, then it shows that risk appetite is here to stay and that it's been driven by that gold price encouragement. So I see that as being a huge sentimental shift, because it's almost as if 12, 18 months ago, there was an attitude which was, well, I'm not going to buy explorers because the gold price might not push their price up. It's gone on to do that. And it's not to say that anyone was wrong. It's more, investor sentiment towards that space, I think, has shifted materially.
Well, speaking of investor sentiment, I'm going to stick with you for a moment, Hedley, and then bounce back to you, Sean. I've seen an increasing larger dollar deals being done with, high net worth institutional funds. Basically, companies aren't struggling as much to raise money, especially in the North American market. From where you sit at your desk, are you sort of seeing deals getting bigger, and do you think there's more M&A on the horizon?
I think what you're talking about there is liquidity, Shae, money coming into the sector, and I think that has definitely increased. Even if you were to look at something which is, a pretty blunt measure of liquidity, which is listing companies onto ASX and looking at the explorers and early stage companies which have listed, there was a period, I think, that extended from late last year until probably mid this year where you just could not list an explorer. It was hard. There just wasn't the money there. There's been about 8 listings, might have been 9 by now, onto ASX since mid-June, and most of them have performed quite well, and some of them have raised money in the 10, 20, $30 million range. So that's a demonstration that liquidity is here, and I think that extrapolates across the sizes of deals that we're seeing in the secondary market where listed companies are raising money. Those are getting bigger. The discount to spot price is lower, and they're getting deals away faster. So that's definitely sneaking in. As for M&A, I think that does play a role. I mean, we've seen opportunistic acquisition attempts or acquisition deals made, probably going back sort of between 6 and 12 months now. When that happens, it's almost like that's a signal where the bigger end of the market says, you know what, I think the smaller companies are cheap enough for us to be able to take a risk on buying them. And sooner or later, the investment market follows, like opens the gate and says, guys, you're missing something here. We're prepared to buy. And sooner or later, the investment market does the same.
Sean, do you want to add to it?
I was just going to say, I have a little IG Markets account. I use it for the charting because it's easy. I have the candlestick charts, and for all the junior stocks, they were just, if you're down, month is red. I always look at the monthly for the long ones. Red, 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 red. For 90% of the red months for 2 or 3 years, and then beginning of this year they started to have a green month, and another green month. And if you think about when we were at the RIU, which we're going to be there again next week with this roadshow, but the RIU Resource Roundup in Sydney in May. Since that time, New World Copper's been taken over, Xanadu been taken over, and Warriedar is under takeover. Those are 3 companies I bought on the strength of presentations I saw over the years at RIU and meeting those people. Delighted, and this is what I love about the RIU conference, getting to eyeball management, really see them say something, come back and say it again next year, be consistent. But for a long time, I've watched presentations and go, yeah, sounds great, but your share price is going down. So smarter people than me are not buying them. I always wait till the smarter people start buying. There's a few green candles, because I used to buy things when it had a red candle because I thought it was smart, and there was a whole lot more red candles after that, which is why I give a lot of my money to Lion nowadays instead, or Lowell, as I've said before. People are much smarter than me. But you can see it in the charts. The animal spirits have been there since, as Hedley said, summertime around April, around the time gold peaked. A few people took some money off the table and started buying some cheap things, but you've seen it. And, I've got in the session that I'm introducing on Tuesday, we've got Ballard there. They've IPO'd since May, and I think they're close to double their IPO price today after a second. So Terra Metals, a company that I had not heard of until I saw at RIU. I think they're up 2.5 times since the RIU Resource Roundup, and they still look cheap. So the animal spirits are definitely back, and it's exciting for a punter coming in on some of these things. It's been good. There's been some nice little movements, and then follow-ons with raisings as well in these companies.
Well, Sean, this is why I love talking to you, because I was going to talk about the benefit of going to these conferences at the end of today's conversation, but bugger it, let's bring it forward. Hedley, Sean hinted at why it's a good thing to come to investor conferences. Why do you think these events are still relevant in a virtual age?
Well, first of all, I'd just like to thank Sean for his support in Lion, and I don't know if he sold his CBA at a high multiple to pay for his Lion, but when he said before, what would you do with your money if you took it out of CBA? What do you buy? Well, I'm a managing director of a listed company, so I've got an easy suggestion to make. The age old adage of a lot of investors, and particularly when you see them interviewed on variety of podcasts and things, the interviewer says, "Well, how do you measure companies? What do you look for in a company?" And the investor typically says, "It's got to be honest and competent management." And people go, "Oh, wow, that's so prophetic. How do we actually measure that?" And you know what? There's no metric for this. This is just something that you have to do yourself. And so for investors to get a grip on that, going to these conferences where you can get face to face with management, you can often do it year after year after year, or event after event after event, and ask them questions. They can be blunt or they can be vague. It doesn't really matter. You're trying to get a feel for what these people are like, measure them, and use your own observation or understanding as to whether you think they're honest and competent. So I think that's the number one rule. That's exactly why I go to these things. And, some conferences gather good groups, some not so much. The RIU has been around an awfully long time now. They have a wonderful franchise of events. And I know that sounds a little bit like I'm sort of sycophantic in motivation there, but they run one in Fremantle, they run one in Sydney, and then they do these road shows. And there is a waiting list for companies that want to go and present there. So you get a well-curated bunch. And that being the case, you're already got a good selection of companies to look at where they've excluded the rogues that they don't want to work with, which is, I think, probably a pretty safe place for people to go and say, well, if I'm interested in this space, I'm talking to a good subset. Now I can start to make my own measurements of whether these people are worth giving my money or not.
Sean, you hinted before that you've bought a couple of companies because you've attended these in-person investor events. Tell me, what's the benefit of walking these conference halls for retail investors, for example?
Well, I think it's quite unusual that you get the kind of time that you do with people, and just to do it. And I say it's not one conference. You go over again. You see these guys. Maybe sometimes you knew them in a different company and they've moved. But like I had Donald Garner, Atani Resources. I've met him over the years in different things. He's in Hedley's session on Wednesday. The last time I saw him, he was just jumping out of his skin with excitement about the stuff they've got and wanting to get out there and drill it. And just on the sheer enthusiasm of talking to him about it, he's not a promoter. He's not a promoter. He was there, so it's on my watch list, and I had some good results. And it's that type of thing where I think you can see people are really enthusiastic about what they do. And I think sometimes, when you do you say in the virtual age, there's a lot of the interviews, and you know how it works, Shae. I mean, a lot of the interviews, people are asking more Dorothy Dix questions when it's online. You're still getting good information out there. You're still seeing things. There's nothing like asking questions for yourself and seeing that. But I think it's also watching the audience response. You get a feel in the audience. And I've met some really smart investors. There's a group who come up from Melbourne, from the RIU things that, they sponsor companies to come and present to them at lunch. And those guys, I'm always wondering, well, what are you guys looking at? And there's a couple of people I've met at the RIU conference where we swap notes. What story did you like? What did you like? Oh, I missed that one. So it's that type of thing. So I used to go to these conferences purely to find clients for Noah's Rule. And I realized after a while that I was really missing out on the other opportunity of looking at people from an investment perspective, because most of the early stage ones, they were too early to be a client. So I kind of walked past them, sort of swipe left, or swipe right, whatever it is you do. I don't know. If I get it right, I'll get it right, I'll get it wrong. But, but it was like, I'm not interested in that because that's no good for a client for Noah's Rule. But now I'm looking, well, it's a good to invest and follow, and you can see the ones that will be. But it's just people. And I'm not a good judge of assets. That when I do, that's why I outsource to other people. But if you find the good people who are good judges of an asset, and then the company starts to look good around them, and they've got that support, you can do it. And often just standing in the booth and listening to other people ask them questions, you get an even better sense than asking them yourself, because then you can really watch the body language and the response. So, look, I think it's great. I made myself a promise that I would never buy a stock while I was sitting in the audience on my phone. But at RIU conferences, I tend to break that rule. But there'll be companies that I've seen present for several times. I think it was Waratah was in the last most recent conference, RIU, I went, I am not sitting through one more presentation of these people without owning this stock. I refuse. And I literally just texted my broker and bought some, which was a good thing as it happened with what's happened with Waratah. But probably not good advice for other people to follow, but it kind of works for me.
Texting a broker, I'm very impressed. Way to reveal your age there, Sean. I got an online trading platform, baby. I'm doing it all on my own. Hedley, listen, I want to talk to you, and I've brought this topic up before, and that is jurisdiction risk. Now, I know Lion Selection Group currently firmly has their feet very much in an Australian-centric portfolio, but would you consider investing in other jurisdictions? And this is sort of an unfair layered question I'm throwing at you, because I am seeing an increasing number of ASX-listed companies picking up Soviet-era projects. So I've got to ask, what's out there, and is that something you're willing to risk?
Yeah, jurisdiction risk is something that comes and goes over time. Or, well, the way it manifests in terms of what price you can get assets for, what you can get for them as a, an exit price, and what risk you take along the way. Jurisdictions don't actually change that rapidly. It's just that people figure out what they're really like, and that can happen all of a sudden. So in Lion's 28 years, we've invested globally. We had a period of time where we were focused just on Africa, Asia, Australia. And after taking a whole heap of money out of Indonesia in 2021 and 22, we made a decision at that point to say, let's be focused on Australia for the next iteration. And there were several reasons for that. Jurisdiction risk was one of them. If something goes wrong for us in Burkina Faso, how do we engage with someone in that country where we can get a good understanding of what's really going on? Is there any way that you can influence the government? Is the government actually open to negotiation, or are they just going to make their mind up and go on from there? Now, there was an incident in Burkina Faso some weeks ago now. It concerns a listed company that looks like the government has said, we want to own more of your asset and we're going to take it from you. Still waiting on details for that. But as whatever people say about the government in Australia, and I would agree with them, there are many, many things that we wouldn't necessarily feel a great policy here. Having a project taken away, or having some sort of blow up where a project is put on ice because of something that the government feels, I think it's very rare to absolutely unheard of for that to happen here. Secondly, if there's something that happens in this country because of someone who's not in the government but is crooked, can that be solved? And I think we've got great belief in the rule of law here, because when something goes wrong in a foreign country, it's often not the government that's let you down, it's an individual or a counterpart. So the protections here are far better. So yes, we would consider it. I think for now, though, there are more than enough opportunities for us in Australia. We're getting very adequate returns off of what we are doing here. So would we add that risk to our portfolio? Because at the end of the day, every stock you add could add risks to the portfolio. And at the moment, we just don't want the distraction of something that could take up 3 months of time solid to try and solve a problem on something that could go wrong, and we just haven't understood the risks properly. So we're very happy here in Australia for now.
We've probably got the reverse problem in Australia. You're not worried about the confiscation of assets by governments. I'm more worried about governments investing in directly in mining assets, our taxpayers' dollars, or giving money based on things like what latitude you exist above with NAIF and stuff like that. And those institutions, I think they come from a good place. Like there's a at some very simple naive level that they think they're doing the right thing, but it does worry me that if government's giving money to projects that the markets wouldn't give to at this time, we might be allocating capital to the wrong places, and then you create, a pull on equipment and jobs and vital sort of supplies to the industry. So I think government's involvement in that could cause a bit of inflation and impact the costs in the industry, and it may not be allocated. Government's not particularly good at allocating capital, I don't think, in their sort of history. So we've almost got the reverse problem here of kind of the government meddling in the market than the risk of confiscation. But
well, you raise an excellent point. First of all, you mentioned NAIF, which I believe is the Northern Australia Infrastructure Facility. Now, I don't think there's a lot of retail investors that even know what that is, but you've made a point in past emails with me that you think the NAIF could become the AIF, so the Australian Infrastructure Facility. What do you mean by that?
Yeah, that's my throwaway line. Like NAIF, I don't know what the parallel is, but there's at some latitude that, if you're above that line, you can get money from NAIF, and if you're below that line, they don't. So it's geographically specific, not commodity specific necessarily, although now if you had a critical mineral that was also above that line, well, hallelujah. I think it's a good thing, but I just know I made the sort of throwaway line that by the time this is over and the government wants to get involved in critical minerals and non-Chinese supply and everything, I said they'll drop the NAIF. It was a bit of a kind of a utopia type comment, if you've seen that television show. It'll just become AIF and they'll just draw a line under Tasmania and everything's fair game. Probably not kind, but it was just, I just have a slightly cynical view around those things. But sometimes those projects, that's the only way they're going to go up. They need that government money and they need the more patient capital because it's still debt, but they sit lower down in the stack to try and bring other commercial lenders in.
Well, Hedley, I'll jump to you for this one. Wouldn't we argue that, a lot of Australian companies in rare earths or the more obscure metals are struggling to attach investor interest could do with government support? Hedley, do you support this type of intervention, or would you rather them step out and let the free market deal with it?
Well, the thing is that when the government steps in and says, hey, we need more rare earths, let's go and support these companies, they have to make a decision on who they're going to support because they can't support everybody unless they think of some disastrous technique like eliminating royalties across an industry group, which, the whole country has to benefit from paying these royalties being paid. So there's all sorts of unintended consequences from all sorts of stimulus that they could provide. As Sean said, I don't think the government is particularly knowledgeable when it comes to allocating capital, particularly in the resources sector. So for them to be doing that, I think is a bit risky. But you might end up supporting something that you think is long-term going to be needed. And, fast forward 3 years down the track, what exactly has the market done? So I think if you're a government and you want to promote minerals coming out of the ground in order to meet a strategic objective, invest in the strategic objective. So if rare earths are going to go into submarines, start building those submarines as fast as you can, and the market price for the consumables that go into it will take care of the rest. It'll drag them out of the ground. But if you provide an artificial price to make a project work so that you can buy those things, I think it's just fraught with risk.
If governments had been involved in when the videos first became, they would have backed Beta for sure.
Yeah. Well, I'm going to get this story wrong, but the Second World War, there was, a huge push to be pulling minerals out of the ground in Australia. And there was, at more or less the same time, the global economy shut down because one of the biggest purchasers of metals had been either Japan or Germany. And they both became whatever the jurisdictional word for persona is. They were persona non grata in the metals sales world. So, all sorts of efforts had to go into place to try and redistribute those things. And of course, it makes a bit of sense in wartime, which we're not necessarily in at the moment, or not globally anyway. But, that resulted in certain projects getting developed. Mount Isa, I think, had known that was abundant copper within the mineralised system there, but at that point in time, it was lead and silver. The zinc was still problematic. And I think it was as simple as the government saying, look, do you guys think you could start pulling some copper out of the ground because we could really use it? So by becoming a consumer, as opposed to meddling with floor prices, is what leads to those things coming out of the ground. So I think that's probably an analogy which still stands now. If you want to use those things, then start purchasing them and put them into use. Stockpiling doesn't work, nor does floor prices. So you need to make sure that you're a participant in the market rather than trying to adjust the market.
Now, I was going to have a fun little flash up of graphics here for this next section, which is hot or not. And that is essentially, look, gold has dominated the conversation. It's dominated every conference I've gone to this year. Sean, I'm going to start with you, though. Are there any other commodities, metals, minerals that investors could be looking at that are not getting any attention because gold is sucking up all of the oxygen around the markets at the moment?
Silver. I think silver is cheap. I think silver is the only metal that hasn't breached its nominal 1980s high, let alone its inflation-adjusted high, which would be much higher. So I think silver is interesting and it's behaving really well, and this would be one of the longest periods it's ever spent above $40. So I think silver looks good, and I think if you're an Indian and you're going to go and buy something at the moment, if you can get 88 ounces of silver instead of 1 ounce of gold, they're both high in price, but one has better relative value. So I think silver looks interesting. I wear my heart on my sleeve whenever I speak publicly that I have a bit of a soft spot for tin. Tin, I think, still looks very good and got a couple of different things in that irons in that fire. I think tin looks good. I think copper finally is starting to look good. I see Wire, the ETF that I kind of follow, the broad ETF, has taken off. It's been messed around a bit with all the Trump stuff around Trump tariff hysteria that we had a little while ago on copper and the premium in the US, but the copper price quietly looks good. Now, copper is an interesting metal because I can't remember the last time a market was so overhyped and so underperformed for so long as copper. I'm sure other people, there are some people around in the industry that are older than me, Shae, and I'm sure they could tell you some other ones. But no, like, copper finally starting to look good. I mean, Friedland's been filling rooms telling about copper for half a decade, right? But copper looks pretty good. So, but commodities generally look good. But I think we're waiting for oil to turn. There's a few little things there. If oil was to start turning up, that then the broad commodity basket will start to look really good. And I think broad commodity basket is going to be good in the second half or the rest of the year as people take money off the table from other things, CBA and the like. General equity investors start to see commodities as cheap. All commodities are cheap relative to equities. Perhaps equities are overvalued, general equities are overvalued, but you want to have a basket of commodities and you want to start. I think it's a great time to be bottom fishing in some of the smaller development things because there's really some animal spirits down in that part of the market at the moment.
Well, I could do without the oil price taking off because I have a 150-litre petrol tank, so I really need oil to stay where it is because it's suddenly affordable to fill up my car. Hedley, you've got your finger on the pulse. What are you looking at that the market might have missed?
Commodity-wise, Shae, I tend to be driven by what I'm seeing rather than what I'd speculate it's going to do. So, and I'd also put over the top of this a suggestion. So, if you do think that a commodity is hot, there wasn't anything that Sean said before that I disagree with. By the way, I think silver's got a lot of promise. Tin is another one that I've got a soft spot for. Copper is consumable in the new world and the old world, no matter which one we end up with in the future. So. They've all got great fundamentals. Some of the ones which are more dependent on Chinese consumption look like they're sort of, flattening into their doldrums rather than continuing to fall. So perhaps that's a bit of a signal for us as well that, the broader commodities are turning a corner. But the issue I have for retail investors and the kinds of people who are going to be watching this or going to conferences is that if you want to invest in tin, for example, it's very hard for you to go, I'll just go down to the bullion shop and buy myself a couple of coins to put under the bed because then I've got my exposure. Now, you can with silver, just as you can with gold. But with a lot of other commodities, it's harder. I mean, if you decided that you love iron ore, you might have to go and buy a boat and sail around and pick up a load of it, right? So it's just prohibitive. So you find yourself in the equities. And when you buy equities in order to get exposure to these metals, you're not getting exposure to the metals. You're getting exposure to a company which could have, a recalcitrant managing director, a negligent board. The project might be absolute crap that's been overhyped, or it could be the best thing that's existed in that space for a very long time, and anything in between. There's a hell of a lot of stock-specific risk that you take there. So it's just a caution on playing commodities through equities. I do like the outlook for a lot of commodities broadly, but I'd prefer from our investing perspective to be buying things that I think have a fantastic company-specific risk spectrum and then assess the value after that.
All right, gentlemen, our conversation is almost about to draw to a close. One more question for each of you and a free little plug for your presentations that you'll be giving at the RIU Investor Roadshow. Sean, you will be leading the charge at Sydney on the 23rd of September. What are you going to be talking about? Why should investors come along and hear what you have to say?
Oh, look, I'm just really trying to kick the day off. It's just a quick presentation, but the title of the presentation is Expensive Compared to What? And that's really, going back to what you talked about earlier. And that's really the idea that within a portfolio, the relative value of resource stocks, junior resource stocks now relative to the larger resource stocks and other parts of the equity market, the idea of underweighting general equities and overweighting this sector makes perfect sense now. Whatever you think, just because the thing's gone up threefold or fourfold a junior stock, is it too late? No. What's the overall market cap? Look at the opportunity relative to what these other companies are. There's still good value in this sector. And the reality is that it's still the same people in the room. Like you'll know it's time to think differently about resources when you go to these RIU conferences and there's all people that you've never seen before rather than the same crowd that come all the time that we all believe. We're just waiting for somebody. We need the other people to believe. And I think that's what's starting and that's what's exciting. I think the rest of the investing world is waking up to the fact that there's good value here.
Hedley, you will be starting the day on the 24th of September in Melbourne. Can you give us a hint to what you will be talking about?
Yeah, I actually don't know what the title is, and I don't know if Jackson's put a title in there yet. And sometimes when you don't give them a title...
Keynote presentation, Hedley.
Yeah, that's all it says.
So there you go. It's kind of like beige Volvo type of title, and I'm hoping to deliver flaming Lamborghini.
It's giving. I'm doing my homework the night before the assignment's due.
No. I've actually put quite a bit of work into some charts already. I've sort of got a collection of new charts that I want to roll out across a couple of events in the next couple of weeks. So what I'll be focusing on though is this whole sentimental reversal that we've been talking about. 12 months ago, the sentiment was let's not get into this space. Sentiment now is let's get into it. And that ties itself up in the lion clock concept, which we use to describe what we think the stage of the market is. And now, whether we're about to, going through, or have gone through the bottom of the market, I think it's still a little bit early to be putting the finger directly on that. But there's many signals that are pointing to we are coming into much warmer water here. So, it's a great time to be deploying. And we know that when we shift into those things, we don't have 5-minute booms. We tend to have reasonably short, sharp busts in comparison to the length of the booms. So if we're coming into something which is going to be longer than the down leg that we've just had and take us to new heights, I think that's pretty exciting, particularly if you're an investor in the small space, which is what's profiled at the RIU.
I can't believe I've gone through a whole interview here and I didn't mention the Lion Selection Group clock at all. I will throw each of you one more question, so I lied. That was the second last question. This is the final question, I promise. Hedley, what is the clock indicating right now?
Last time we published at Shae, we said 5 o'clock, and that was in May, right? So I've been doing a bit of work on where turning points might be, and I personally think we're probably going through one now. Now, there's a bit of risk in saying, hey, we're right at that turning point, because it's so easy for people to go, wrong, or, it leads to a disagreement. I think it's far more productive for us to be commentating on directionally which way we think we're going. So I think we could very, very easily, in 12 months' time, look back at now, as in August, September, October of 2025, and say we were past the turning point there. So I'm not quite ready to say it, but I'm feeling fairly confident that we might look back at now and think that. And that's just based on extrapolating the conditions that we're seeing at the moment.
Sean, final question to you. Now, obviously, you don't have the fancy Lion Group selection clock, and we've danced around the idea of market sentiment. Do you believe we are at a turning point for market sentiment when it comes to mining-related equities?
Yes, absolutely. Relative to general equities, there's a chart I've been putting up now for quite a few years at these RIU conferences of the ratio of the Goldman Sachs Commodity Index to the S&P, and drawing similar comparisons to the late 90s, early 2000s. And as Hedley said, that idea of are we there yet? Have we turned? It's been like watching paint dry show for the last 3 or 4 years, right? It's like ready. Like, don't shoot till you see the whites of their eyes. I've been guilty of going a little bit early, but no, it does feel like we're finally seeing that turn. And I've been saying for some time, it's actually general equities rolling over that I think is what we really need. I really don't think we have a really significant move in commodities until the mood for general equities softens, or simply people think they're so overvalued, as was the talk of CBA several weeks ago now, that they're just so overvalued that people go, okay, I've got to take some money off the table. And then their brokers are not so, because a lot of people still do use brokers, Shae. Their brokers are not going to let them take that money back. Like, where are they going to put their money? And even if they've got an online platform like you do, you're not going to put that money back in the bank. So you're going to look for something else to put that money, because that money's in the system and you don't want to take that money out of the system. So it's going to trickle down from the top into our sector. And as our sector performs better, then there'll be more motivation to come to that level. But I think we are at that point, which fits in nicely with Hedley's kind of clock, that we're at the bottom, that the other markets are at the top and we're at the bottom. and you're taking money off the top in those markets. Where you're going to put it, you're going to look for value. And there is no doubt, I'm looking here on my other screen at the companies that are coming. And I think I own 5 of the 14 companies that are presenting in the session I'm leading off next Tuesday. And you look at the charts of all those companies and you look at the stories they're telling, and it's very exciting, and it looks like there's lots of potential upside. I look at the CBA chart and it looks a bit flaccid. So I know where I'd rather be.
Listen, gentlemen, I want to thank you so much for your time today. For everybody who listened, who enjoyed this chat and would like to hear more of it, please find the link below and you can register for your free pass to attend the RIU Investor Roadshow in either Sydney or Melbourne. Sean, Hedley, it is always an absolute pleasure to speak with both of you. Thank you for your time today.
Awesome to chat.
Thanks, Shae.